Hi, everyone. Welcome to UOB Private Bank podcast series. And today we are going to talk about inflation, a global phenomenon. Now, this has been familiar headlines in the media recently, not just in this part of the world, in Asia, but also in the United States and in the Western countries. Seemingly seeing that inflation is affecting everyone else, and inflation not just in the prices of gasoline, in food, in energy, but also in housing as well as vehicles. So is inflation really a true and widespread phenomenon? Indeed, it is true. Now, over here, we do see that across a survey sample of 53 economies and regions around the world, 72.4 of the economic regions are saying that they are seeing an inflation much higher than the 2% target that their central banks are looking at. So what this means is that since we had a low base over the last 2 years back in 2020 due to the pandemic, the global demand or the global economic growth has been so strong that it has been pushing inflation back up onto a higher than expected trend already. So why is inflation a global phenomenon? There are two reasons. Number one is basically on the back of a very successful monetary and fiscal stimulus during the recession. Now that from the policymakers of the world had helped to support the economies, thus putting money into the hands of the consumers. Of course, during the first few months of the pandemic, everywhere else was closed, nowhere was open. The monies were still in the hands of the consumers. However, as many economies start reopening, they started spending, and that helped to push up the inflation to a next higher level. The second reason is mainly due to the Russian-Ukraine war, where Russia is one of the major oil producers in the world. And also a structural trend was that there has been an underinvestment in oil exploration and production due to the shift towards clean energy over the past few years. Now, the conflation of both a near-term issue, which is the Russian-Ukraine war, as well as a structural issue, which is the underinvestment in oil, certainly has brought global energy prices much higher than we expected and translating into higher domestic inflation across many countries in the world. Now, why is that a concern? Indeed, investors, because of the recent hike in oil prices, have been thinking or drawing back their memories of the 70s, whereby on the left-hand side of this chart, you can see back in the 73 or even in 79, international oil prices moved way above their long-term average, and that caused recessions globally. So right now, as investors are saying that, oh dear, are we seeing a repeat of that? Will that bring about recession globally? Certainly concerns do come up. However, we don't think so, because there are a couple of trends right now that we're seeing that's very different from back in the 70s. For one, mainly it's because the average American consumers are not spending as much on oil as a total expenditure, a percentage of their expenditure. Right now, the average American is spending 3.5%. But back in the 70s, back in 79, the average American spends nearly 16% on oil as a part of their total expenditure. So the average American is not as reliant on oil. And secondly, mainly because the America has gone on into domestic oil production. So the reliance on international oil imports is not as high as back in the 70s. So overall, that should not pass through too much into the American inflation rates. However, what is of concern right now is the demand pull type of inflation. As we can see from this chart over here, American inflation is still pretty sticky at 8.5% for headline and 6.5% for core inflation. As mentioned, the main thing is because of the very tight labor market. Now, on the left-hand side, we can see that currently around 4.35 million Americans are quitting their jobs on a monthly basis. This is mainly on the back of a very healthy and robust economic growth in the US. If you can see over there, during the pandemic crisis or during even the global financial crisis, quit rates dropped to an all-time low. That is because they were very uncertain about economic growth. So naturally, quit rates were low. But however, as the economy starts picking back up, we do see a big trend in those that are quitting jobs. On the right-hand side, the number of job openings in the US is very, very high as well. In fact, at a historic high of 11.27 million. So what this means is that employers increasingly are finding it very hard to get workers, even though their expected demand for their goods and services are extremely high. So that will mean that they are going to fight over having workers to work to fill up the job vacancy, and that is going to cause a sustained upward pressure on wages, which at the end of the day will also push inflation rate much higher. So because of that, the Federal Reserve in the US is going to look very much into monetary normalization. And by normalization, it means two things. Number one, reducing the balance sheet that they have accumulated since the pandemic started. And number two, on this chart, basically hiking the interest rate. Now, even though the Federal Reserve has hiked one rate back in March 2020, now the market is still expecting for 8 more hikes this year. So putting up a very much hawkish monetary normalization that we'll be seeing in just a couple of months ahead of us. So that said, the near-term 1 year ahead US inflation expectation is still pretty stubborn, hovering around 6.6%, although the next 3 years, the American inflation is expected to come back down to around 3.7%. Now, why is that so? Mainly because the Federal Reserve has just only started the rate hike. They have not gone through the entire rate hike schedule. Because of that, and because of the very tight labor market, as mentioned just now, the next 1 year, we are likely to still see very stubborn high inflation numbers. However, because of the rate hike expectation coming up from the US over the next 3 year period, we are likely to see the inflation environment getting much more dovish. So in summary today, inflation is a laggard indicator. It is simply a result of the fast growth from previous period. There's nothing to be fearful of inflation because central banks, policymakers will come in to mitigate this sharp rise in the inflation as a result of the fast growth from the previous period. And second one, the higher international oil prices will not eventually pass through much to US inflation because the average American spends less on energy right now compared to the 1970s. Next, the US certainly right now is less reliant on energy imports because it has developed a strong domestic production in oil. And the Federal Reserve this time around is a lot more closely watching the labor market tightness because this will be causing demand pull inflation. Lastly, near-term inflation expectations will still be high, and we are expecting the Fed to be tightening going ahead with a hawkish tilt. Thank you very much for tuning in, and do stay tuned for the next podcast. Thank you.